especially China and the other global south nations. They've been increasing their net holdings of gold over the last 3.5 years. And I think now the Chinese are thinking, well, we need to get financial institutions to do the same. And I don't think they had any provisions for insurance companies. So they announced in February that they could have up to 1% of their assets in gold. And Elijah, the more I see the way the world's evolving, geopolitically, trade-wise, economically, I think we're in for some turbulent times ahead. And I think more and more countries are trying to be less dependent on the dollar.
China and other nations in the global south have been steadily increasing their gold reserves. The People's Bank of China added gold to its reserves for 17 consecutive months, making it one of the most consistent official buyers in the world. Recently, China began encouraging its financial institutions, such as insurance companies, to hold gold, now allowing them to allocate up to 1% of their assets to it. This move reflects growing global efforts to reduce reliance on the US dollar amid rising geopolitical, trade, and economic instability, suggesting turbulent times ahead. Mario Innecco exposes that wealthy family offices still hold very little gold, just about 2% of their assets, despite rising global uncertainty. In contrast, China is encouraging both institutions and the public to increase gold holdings, even allowing regular bank customers to open gold accounts. This shows growing interest in gold globally, while Western investors remain cautious. Spot gold prices have reached record highs in 2025, fueled in part by China gold demand. The Shanghai Gold Exchange has reported significant year-over-year increases in trading volume. Traders are monitoring changes in capital controls that may affect gold imports. US-China tensions remain a wild card in determining future gold policy. Central bank policies, both in China and abroad, will play a crucial role in determining the direction of prices. Meanwhile, confidence in currencies tied to the dollar is fading, and recent US bond auctions have shown mixed demand. Traditionally, rising US Treasury yields attract foreign investment, strengthening the dollar. However, recent trends indicate a divergence, with yields rising while the dollar depreciates, signaling a waning of investor confidence. Political and fiscal instability, including concerns over the Federal Reserve's independence and the impact of new tariffs, have contributed to the weakening of the dollar. Even figures like Elon Musk have criticized recent U.S. fiscal policy, warning that America can't afford both massive spending and economic beauty. Before we begin, don't forget to subscribe and hit the bell icon for updates. Please share your thoughts in the comments and let us know if you find the content valuable.
Aside from the sovereign nations buying gold for their central banks or treasuries, if you look at the so-called smart money, the family offices, I saw something from UBS. I think it was in Gold We Trust, the Ronald's shop in Liechtenstein, Incrementum AG. That's what the name I wanted. He had a bar chart, and these family offices are like private hedge funds for the most wealthy families on the planet. They still only hold 2% of their assets in gold. It's not much, 2%, and 1% in commodities, and the rest is still mostly stocks and bonds, private equity. So yeah, the public hasn't even really their toes in the water as far as gold and silver are concerned. In China, though, they're also pushing. They've been pushing for the last few years for the public to buy gold. They have special gold accounts. You can open a gold account at a normal bank. I mean, we can't do that here in the UK. Banks haven't dealt with gold for decades here. So yes, we're still not even in the mania phase at all for gold. It's not just the dollar that they're losing faith in. It will also be their own currencies because they've been a derivative of the dollar. But as for the bond market, yeah, there was a 20-year bond auction, I think last week, and demand wasn't great. The dealers, the primary dealers who work with the Fed, they had to step in to buy a little extra. Even the Fed stepped in. But I think, demand's still there. I mean, yesterday I think they had a 7-year note auction, and then that went quite well. But as I spoke with you before we got on, there's a lot of talk now about a provision in the big beautiful bill. It's a section in it, 899. And it talks. It gives the Treasury power to tax foreign investors, and some people are concerned that it could apply to U.S. Treasury coupon or income, even though there's like an international understanding now that you shouldn't have withholding tax on interest income from government bonds. So I think that puts more uncertainty into treasuries. And after August, I think there's going to be like $7 trillion to roll over only this year of all the debt that has been accumulated and hasn't been able to be rolled over because of the debt ceiling. I think it's a huge problem. The technical picture for let's say that's been the case since 2020. Yields have been rising. We've had some kind of consolidation since for the last year and a half, but we could very easily see yields spike again. Maybe that's what Trump and Powell were speaking about yesterday at the White House. I know Trump told him that he was wrong not to cut rates, but I had a look, Elijah, since the Fed cut rates last year in September by 50 basis points, they cut another 2 times by 25, and the 10-year yield is actually up almost 1%. It was at around 360. When they started cutting, and it's now around 440. So I'm not sure if cutting rates is the solution. I'm not being partisan here. I'm just giving you the facts. But we're seeing a few weak numbers as well. We saw PCE today came in a little lower than expected, the core and the headline number, and we've seen jobless claims jump up to like 240. So maybe bonds will stabilize a little bit, but over the medium to long term, I think it would be a big problem for the Treasury, for refinancing, and the cost of interest expense. Even Elon Musk came out the other day and said he's not impressed with the big, beautiful bill. He said you can't have a big and beautiful. You can only have one or the other.
Mario highlights. Since the current U.S. administration began, the dollar has weakened significantly, reflecting a broader trend of global currency devaluation. The idea that a weaker currency boosts exports is flawed, as it also raises import costs, especially for manufacturing inputs. Unlike many countries, Switzerland has maintained a stable currency and remains a wealthy nation. Globally, all fiat currencies are declining in value relative to gold in a race to the bottom. Inflation, fueled by decades of monetary expansion, is now affecting consumers, not just financial markets. Governments may manipulate inflation data or impose price controls, but such measures are likely to fail. Truly defeating inflation would require a severe economic contraction, something no politician is willing to risk, as public expectations remain rooted in government support funded by unsustainable monetary policy. Over the past few decades, Japan's policy of low interest rates and a weak yen supported the yen carry trade, where investors borrowed cheap yen to invest in higher-yielding assets abroad. However, with global interest rates rising and Japanese bond yields, like the 40-year, climbing above 3%, Japanese investors are repatriating funds, strengthening the yen. This puts pressure on those with yen-denominated debt, forcing them to sell off foreign assets to repay loans, which can trigger broader market disruptions. A strengthening yen and rising Japanese bond yields could signal stress in global financial markets and spark a contagion effect.
Administration started on January 20th. The dollar has dropped from like 109 on the dollar index to around 100 right now. So yeah, it has come off. And I mean, it's the Keynesian fallacy as well, that if you devalue, your exports will go up and it will cut the trade balance. But I've never seen a country around the world, and there are many examples of this, especially in the third world, countries that devalue and debase their currencies, they never become wealthy and export things, because a lot of times you also have to import like intermediate goods or commodities to produce the finished goods, the manufacturing goods in the U.S. So if your dollar is weak, it's going to cost more. And an example of a country that has not really had a policy of devaluation is like Switzerland, even though they've tried their best to keep the Swiss franc as weak as possible with no success, because it's still a strong currency. And they don't have such a bad history of devaluation, and it's a wealthy country. So and that's the way I see it. And I think it is the policy of the Trump administration, a weaker dollar. And I think it will be particularly pronounced versus gold. But that doesn't mean to say, Elijah, that other countries are also not going to devalue versus gold. So it's going to be a race to the bottom. And that's why it's not just the dollar that's going down the drain. It's all of the fiat currencies. I mean, we've had inflation for decades, if you look at the money supply, because that's the true definition. But I know what you mean, the CPI. Yeah, that has gone up. And what was happening prior to 2022 is that every time the government and the central bank inflated the system fiscally and monetarily, all that credit and currency went into financial assets. This time, it came out of financial assets like stocks and bonds and went into consumer goods, and people feel it. And I think yes, the government is how are they going to react? Well, they're going to tinker with the data. They're going to find new ways of revising the CPI, just like they've been doing since the 80s. If you look at Shadow Stats and John Williams, they've done it here in the UK in 2022. It chopped off like 1% off CPI. And the other thing they're going to do, I think, even if we have a Republican administration, they're going to bring in price controls. I think that's what Richard Nixon tried to do. And all of those things are going to fail. And people are not going to be happy. They're going to be more and more unhappy. Yes, you can try to get OPEC to produce a lot more oil and bring the oil price down, but that's not really bringing inflation down. It's just bringing oil prices down. So ultimately, I mean, the way to kill inflation would be to have a massive recession, massive Great Depression. That's the only way to eliminate a lot of that funny money that's been put onto the money supply over the last few decades, especially the last 15 years. So I don't see any politician, be it in the U.S. or in Europe, wanting to do the right thing in terms of that, because the general public still expects Peter to pay Paul. As I mentioned the other day, Frederick Bastiat, he said that the state is the great fiction by which everyone wants to live at the expense of everyone else, and it still applies the last couple of decades, because the Japanese authorities, they've had a policy of keeping the yen weak and keeping rates at zero or negative. But now with rates all around the world going up, even though the Japanese central bank, the BOJ, is still doing I think $40 billion of QE every month, they haven't been able to keep their bond yields low. For example, the 40-year has gone from near zero or even negative 4 or 5 years ago to over 3% now. So what that does is that it makes the yen stronger, because Japanese investors, they're bringing a lot of their funds home because they can get a higher yield in Japan. So that strengthens the yen. The people who have borrowed in yen, who did the carry trade, they're getting crucified on their borrowings in yen because the yen's going up in value and the cost of borrowing is going up. So what they do is they liquidate their higher yielding assets in the West and to close out that trade. And so the thing to do if you want to keep track of the Japanese yen carry trade is to see if the dollar is dropping a lot versus the yen, that's a bad sign. And also to see if the 10-year and the 40-year JGB yield, if they start going up and the yen starts going up, and that's bad. Right now it's kind of stabilized, but it could affect U.S. financial markets, European financial markets, and it could have like a domino effect, contagion.
The global financial landscape is undergoing a profound shift. China and other nations in the global south are aggressively accumulating gold, signaling a strategic move to diversify away from the US dollar amid growing geopolitical and economic uncertainty. This trend contrasts sharply with Western institutions, which remain underexposed to gold despite rising inflation and the devaluation of fiat currencies. The weakening US dollar, driven by fiscal instability, diminished investor confidence, and flawed economic policies, further underscores the shifting balance of power. Meanwhile, Japan's repatriation of funds due to rising domestic yields may introduce new volatility into global markets. These developments collectively point to a more multipolar and less dollar-dominated global economy. How might increased gold accumulation by China reshape global monetary reserves and influence future international trade settlements? Could Japan's repatriation trend and rising yen trigger a broader financial contagion in over-leveraged global markets? Feel free to share your thoughts in the comments. If you found this content helpful, give it a thumbs up and remember to subscribe to stay updated.